If you're in the market for an investment property, keep watching because I'm going to give you some helpful information when it comes to down payments on investment properties. I'm sure you're wondering, what is the minimum amount I'm going to need to put down on this property? When it comes to purchasing an investment property, most lenders are going to require a bit higher of a down payment than they would on your primary residence. The size of the down payment varies widely based off of the type of loan that you pursue. Today, I'm going to give you some helpful information about different loan types, but first, let's quickly go over all the things you're going to need to get approved by most lenders for a loan. Minimum of a 680 credit score, minimum of a 15% down payment, 50% or less debt to income ratio, 6 months or more in cash reserves. Lastly, they will take into consideration your current home loans, but for the most part, you can have up to 10 investment properties through a conventional mortgage. It might seem daunting thinking about how you're going to come up with the cash to cover 15 to 20% down, but there are a couple of ways that real estate investors make it work. Number one, a HELOC or home equity line of credit. This is a type of credit that allows you to borrow against your home equity. There are some risks with this one, like if you miss your HELOC payments, your lender could foreclose on your primary residence. Number two is a private lender. They often work with real estate investors by providing more flexible funding solutions, and some can even offer down payment loans. The third is a self-directed IRA. If you've been setting aside cash in a self-directed IRA, you might be able to tap into that money for a down payment. One thing to note, the IRS will require that all expenses for the property be paid out of that IRA. Four is group investing. This one might seem self-explanatory, but if you have friends or family that you trust to go in on an investment property with, this is a great way to come up with funds quicker than you'd be able to alone. Five is a bridge loan. This is a short-term financing solution that can help you come up with the funds for a down payment. It's a relatively common way for real estate investors to obtain the property, and then once the deal is done, they opt for a more favorable loan like a conventional. Number six is seller financing. This option involves the seller of the investment property acting as your bank and is helpful when the buyer has limited cash. Last but not least, number seven is house hacking. This is a strategy for multi-unit properties where the buyer agrees to live in one of the units and rent the remaining units out to cover the cost of the mortgage. This is a great option if you don't have enough cash to cover 15 to 20% for the down payment, and you can make the living situation work. With this option, you're getting a loan designed for a primary residence and could potentially put significantly less money down, sometimes as low as 3%. As a quick review, in general, real estate investors are going to need to put down a minimum of 15% to obtain the property. But there are several financing options available to make your dreams of owning an investment property come to life. If you're just starting out on this journey, make sure you talk with a financial advisor.